Something is unraveling across the United States, and most people don't even realize they're living through it. What began as a slow cooling in a handful of boomtowns has quietly transformed into a national reversal, one that carries the same eerie signs seen in the earliest days of the last major housing collapse. Homes that once sparked bidding wars now sit untouched. Prices that surged year after year are suddenly slipping. Inventory is swelling in markets once considered untouchable. And the latest data from late 2024 and early 2025 doesn't just suggest a slowdown. It shows a U.S. housing market falling faster than anyone expected. For years, Americans were told the housing boom was unstoppable. They were told that inventory would stay low forever, that demand would always outpace supply, and that home prices would continue rising no matter what. But by late 2024, the illusion began to crack. In cities like Phoenix, Austin, Tampa, Denver, and Seattle, the same places that once saw homes sell sight unseen, prices began slipping month after month. At first, it was subtle, a few $1,000s here, a few price reductions there. But within a year, the drop accelerated. 6%, 8%, even 12% declines in certain metros. Homes that once sold within 48 hours suddenly sat for 45, 60, even 75 days. Sellers who never imagined lowering their asking price were suddenly slashing numbers week after week. By early 2025, the shift wasn't local anymore. It was national. Active listings across the U.S. surged by 32% year over year. That alone would be alarming, but the spike in certain markets was far worse. Cape Coral inventory jumped 41%. Austin rose 38%. Salt Lake City climbed 36%. Tampa increased 33%. Even Las Vegas, once one of the strongest markets in the country, saw nearly a 30% surge in homes hitting the market. This wasn't competition returning. This was a wave of owners racing to sell before prices fell further. A wave of investors dumping properties they once swore they'd hold for decades. A wave of supply hitting at the exact moment buyer interest evaporated. And that evaporation wasn't subtle. Mortgage applications across the country fell to a 28-year low. Affordability collapsed to its worst point in more than 3 decades. In many regions, the typical household would now need to commit over 40% of its income just to cover the mortgage, taxes, and insurance. The market wasn't becoming a buyer's paradise. It was becoming no market at all. Buyers weren't waiting for rates to fall. They had already stepped away entirely, priced out, stressed out, and unwilling to gamble on unstable housing costs. Even cash buyers, the backbone of markets in Florida, Texas, Arizona, and Nevada, pulled back sharply, dropping by 22% year over year. And when cash retreats, the last oxygen in the market disappears. But the most devastating blow didn't come from interest rates or inventory. It came from the one factor almost nobody accounted for: insurance. Beginning in 2023 and exploding in 2024 and 2025, insurance became the silent destroyer of the American housing market. What started in Florida became a nationwide crisis. Premiums rose 40%, then 60%, then in some risk zones doubled entirely. In wildfire-prone regions of California, major insurers simply pulled out. In Gulf states like Louisiana and Texas, some families saw their insurance bills climb above their mortgage payments. In Florida, premiums soared to triple the national average, with some coastal homes costing $10,000 to $15,000 a year just to insure. Buyers who thought they had budgeted safely suddenly realized that they were thousands of dollars short every single year. A house is not affordable if you cannot insure it, and millions of Americans are discovering the new reality. Ownership now carries risks they never prepared for. Real estate agents across the nation are witnessing a shift they haven't seen since 2008. They describe open houses where not a single person walks in. They talk about buyers backing out halfway through escrow, citing fear or unexpected insurance quotes. They see sellers cut prices 3 or 4 times, each drop more desperate than the last. Agents describe walking into homes listed as occupied, only to find no furniture, no signs of life, and utilities barely being used. Suburban neighborhoods look normal during the day, but at night, entire streets remain pitch black. No lights, no activity, no movement at all. For the first time in more than 15 years, agents are repeating the same phrase across multiple states. It feels like the oxygen has been sucked out of the market. And behind that silence lies a growing desperation. Homeowners calling their agents daily, asking how fast they can sell, asking what the lowest acceptable offer should be, asking whether they should walk away entirely. Investors who bought aggressively during the pandemic boom now face vacancies, shrinking rents, and mounting insurance costs. Many are rushing to offload properties before the decline accelerates further. The numbers confirm everything that agents fear. By late 2024 and early 2025, days on market ballooned across the country. Homes that used to spend 8 days on the market now took 55, 60, even 70 days in certain metros. More than 35% of all listings saw at least one price reduction. Foreclosure filings rose 26% year over year. New home cancellations climbed as buyers realized they couldn't afford the final payments. Rent growth, which exploded during the pandemic, flattened for the first time in 15 years. Even population migration, long the engine of Sunbelt growth, slowed sharply in states like Florida, Texas, and Arizona. The cities that soared the fastest, Boise, Austin, Tampa, Phoenix, are now dropping the fastest. But the slowdown isn't limited to volatile markets. Traditionally safe regions like Denver, Minneapolis, Boston, and Raleigh are showing weakening demand and rising inventory. Even luxury homes, believed to be invincible during downturns, are sitting longer, dropping in price, and losing their competitive edge. This isn't a cluster of local weaknesses. This is a national pattern, spreading quietly across the U.S. with every passing month. And beneath these statistics are millions of people living through the consequences. Families who stretched their budgets to buy during the pandemic now face insurance premiums that wipe out entire paychecks. Retirees on fixed incomes watch HOA fees, special assessments, and taxes rise faster than they can adjust. Young buyers realize their homes are worth less today than the day they closed. Airbnb owners who once relied on tourist demand now face empty calendars and shrinking income. For many Americans, the dream of homeownership is transforming into a financial burden they can't escape. Emotionally, the toll is overwhelming. Couples delaying children because the cost of housing is too high. Families forced to relocate after rising premiums make staying impossible. Investors abandoning properties they once considered long-term wealth. Streets growing quieter, neighborhoods losing life. What used to be a symbol of stability, owning a home, has become for many people a source of stress, uncertainty, and constant risk. The U.S. housing market is now approaching a crossroads unlike anything in recent memory. If prices continue to fall, millions of homeowners could slip underwater, owing more on their mortgages than their homes are worth. That could trigger a surge of strategic defaults, just like 2008, as people walk away from properties they can no longer sustain. If insurance keeps rising, entire coastal regions may see mass migration, leaving behind neighborhoods full of unsellable homes. If mortgage rates stay elevated, demand will remain frozen, and inventory will keep swelling. And if a recession emerges during this fragile moment, distressed sales could multiply, accelerating the downturn. None of the pressures on this market are temporary. They are structural, they are intertwined, and they are worsening. The U.S. housing market isn't simply cooling, it is shifting under the weight of affordability crises, insurance failures, migration reversals, investor withdrawals, and an economy struggling to support the levels of debt Americans now carry. The cracks in the system aren't hidden anymore. They're widening, spreading from city to city, from suburb to suburb, from state to state. And as the nation watches this slow-moving shift unfold, one question rises above everything else. Is this the beginning of a correction, or the start of a collapse far greater than anyone is prepared for?